All righty. Happy Wednesday, everybody. Welcome to the show. Welcome to another webinar with Lexington Capital Holdings. We are a loan brokerage where we are bringing to you guys information, education, and advice on how to deal with business lending, whether you're a broker, you're a business owner, you're a lender looking to navigate how to help these business owners apply for financing and just obtain the right financing for your business, or just be aware and educated so you know how to plan for financing. So this particular episode, we're going to go over the SBA and conventional term lending, the three different tiers. And so your tiers. Oh, okay. Actually, let me just take a step back. We're going to give everyone a minute to join first before we dive into the meat and potatoes. I see people trickling in. All right, ready to go? All right, so we're back. So happy Wednesday, everybody. Welcome to another webinar with Lexington Capital Holdings. This episode, we're going to uncover the three tiers to traditional business lending and SBA lending. And that would be collateral, credit, and what's the third tier?
Debt service coverage ratio.
Debt service coverage ratio, or you can call it cash flow to make it all C's. All right, so my name is Travis Teng. I am the director of the SBA department. And this is
Nick Lovags. I'm the co-director of the SBA department here at Lexington.
Yes, sir. And we essentially manage our operation here for all kinds of SBA or conventional financing. And this episode is going to give you a layered perspective on these three different tiers, because our department was founded so we can always have a home for business owners that are not looking for alternative capital, not looking for fast, easy financing. They may have, qualified financials. They may have high credit scores. They have several years in business that are established, and they need to go for bigger loans. This is where we come into play. And when a business owner says, I need something traditional and monthly, it's never as straightforward as saying, yes, all right, sounds good, we can go do this for you. And so this is the reason why we created this specific episode, to kind of just tier it all out and make a little bit more sense. And that's kind of the foundation of our service, right? It's a product of service where we consult with business owners and we spend time with them to really break down, what option makes sense for their situation before we make them go apply for things. Because usually, as a business owner, when you go apply with a banker, what are some downsides? And what's the opposite of experience you would get? Besides that free consultation when you go with the banker, Lovags.
When you go with a banker, there's just a lot of miscommunication. You don't get the free consultation that you do get with us. We're willing to underwrite your file, look at your whole business profile, and figure out what the best solution is. And using these tiers, we can kind of dictate where we want to go or what you qualify for.
Exactly. And that's the most important thing. Like he said, we underwrite the file, and we're not underwriters, right? So we're going the extra mile for these business owners, because lo and behold, all these different tiers of lending, collateral, cash flow, credit-based, most banks can do all of them. And so a bank wouldn't mind wasting your time, making you send 50 docs, because what they'll do is they'll analyze every product possible. And once at the end, you have 2 feet committed into the process, you spent all the time already, all the paperwork. If it turns out you can't get what you originally wanted, then they'll try to cross-sell you into something else that they offer as a bank. And that's why as a broker, we will never do that to you, because we will make sure we give you the most efficient process and we deliver on what you requested. And so we're going to go into different aspects for each type of financing to really give you a good understanding on how it all works. And so we'll give you the premise on these different tiers of lending. We'll give you common requirements, besides the distinct requirements. And we'll also give you examples on when a borrower should go one way or the other, whether it's going collateral based, whether it's going cash flow based, whether it's going credit based. And we'll also give you a little bit of a nice SBA versus conventional breakdown, since SBA loans and conventional loans are essentially one and the same, because SBA banks are conventional lenders. They're just using the SBA platform to back their loan. And so we'll also give you a little bit of a nice pros and cons between both, and you can really understand what might be better, what might be worse, and which one is situationally more appropriate for you to apply for. And so to start off, we're going to go with tier number 1, right? The most complex type of financing, and that's collateral-based business lending. And so, Nick, what are some common requirements, distinct requirements you would have to be able to satisfy before you consider, a collateral-based loan?
Yeah, it's a great question. So when we're looking at a collateral-based loan, right, whether it be SBA or conventional, you're going to be looking at a global debt service coverage ratio, right? Basically, what is a debt service coverage ratio in itself? Basically, we're saying if you can service debt, right? We're looking at the business owner's debt, not on both the business side as well as the personal side, right? So that's the first thing, right? And obviously, these banks that we work with have different metrics to navigate that, right? Obviously, for the conventional side, we're looking for existing relationships, as well as on the SBA side, we're looking at more of the business plans projections. So those are the distinct requirements you want to look for beforehand. Now, can you give us maybe some differences between SBA and conventional, like for the collateral-based side?
Yes, and actually one more thing I wanted to touch upon is the global debt service coverage ratio. So there's certain loans out there where there's a debt service coverage ratio. They're looking at business, essentially DTI, right? What are you profiting on the business cash flow and what are you spending in debt? Global is a little bit of a bigger picture because they're looking at personal. So very important to distinct that, when you're going collateral-based lending with these bigger loan amounts, they're looking at the full picture, on personal and business debt. But as far as, SBA versus conventional, some, nuances between, if you went SBA or you went conventional for your financing is what kind of collateral they require. So usually a conventional lender or an SBA lender would require similar collateral, things like title vehicles, title machines, or expensive machinery, business assets, that are hard with value, owner occupied commercial real estate building, right? If your business operates out of the building and you own it, that can be used as collateral for your loan. And as far as, nuances, conventional lenders can usually also use, ARs for financing, and they can also use what's it called? Equipment for financing. So you have AR financing, you have equipment financing, and you have inventory financing. So I take that back, not equipment. Conventional lenders have certain programs where these banks will specialize in strictly financing you based on your expected receivables and also based on your, I keep running, what was it? Invoice factoring and what was it?
AR.
Inventory financing. All right. So conventional lenders have that as an option, which SBA lenders typically don't finance based on invoices or inventory. But SBA lenders are a little bit different because they can sometimes allow you to use personal collateral to make your loan work. And just to take a step back, with the collateral, how much you would need for collateral. Usually for a loan that's, requiring collateral for a bigger loan size, the collateral needs to match the loan value. All right. So let's say you go SBA and the business assets are only worth about $100,000, but the loan you're applying for is $500,000. An SBA lender will allow you to use your personal home to make up that equity, that collateral, the loan value. They will allow you to use personal liquidatable assets. This can be a cash value life insurance policy. This can be a stock portfolio. We've even seen sometimes clients use 401ks, to collateralize their loan. And most conventional lenders will not be as flexible. They will usually be a little bit more stringent, requiring business assets to match the loan amount. And so
they want to see majority of the time it's going to be equal to the loan amount for the collateral on the conventional side. That's what they want to see. And to kind of add to that, SBA, there's a little bit more leniency with that as well. Like I said, there is the business plan projection side of it as well. So where we can make up with, let's say, without collateral or without a debt service coverage ratio, we can make up for that in a business plan or projection showing that there will be growth with these funds. You're allocating these funds the correct way so that we can get to the right mark. That's in essence what we can do on the SBA side, and so why somebody might even want to lean towards that route.
Correct. So, even as far as, starting with the collateral, what you're able to use as collateral, SBA is usually more flexible. And then if they don't have the cash flow on paper, SBA is more flexible because they allow you to use business plans and projections to secure the loan and apply and qualify for the loan. Meanwhile, your conventional lender will usually require those hard collateral requirements, not allowing the personal assets and also not allowing you to use business plans and projections to get the deal done. And so this is where SBA is kind of winning in those aspects. Now, if you are using your personal home or real estate personally to collateralize an SBA, it's worth noting that they don't allow you to use it unless it's over 25% equity available in that property. And so moving onward, another aspect where you can compare SBA versus conventional is down payment requirements. So for certain types of loans that are, based on purchases, say you are purchasing, the building you're going to operate out of, or another building you want to, operate your business out of, or you're buying another business, you're going to usually be required to provide a down payment of 10% of the loan amount when you're going SBA. When you're going conventional lenders will usually require you to put down anywhere from 25 to 35%. And so again, SBA is essentially winning in all aspects for collateral as far as just upsides. But like Lovags, mentioned earlier, when you're going conventional, if you have existing relationships, say you have an auto loan with that bank already, say you've already been banking with that bank for the last 5-10 years, your business operating account, all your money's in that account. Say you already have a mortgage with that bank. If you have that built-in history, all that red tape and low chance of approval that the banks get the bad rep for kind of goes out the door, because you usually get approved a lot more streamlined than any other product you're applying for without that relationship.
Very true. Something else to add there is, with SBA, there is a certain cap that we reach at, right? So SBA is capped at 5 million. That's how much they can lend out to. Now, for manufacturing, it's 10 million. When you're dealing with a conventional bank, it's the sky is the limit, contingent on credit profile, collateral that you do have, and like I said, strong financials, definitely backing that. But that's something that you might want to lead conventional, is that you can get additionally more than $10 million, $5 million. It's there is a little bit of nuance when it comes to that. So
that's absolutely correct. At the end of the day, a conventional bank doesn't have as many rules to abide by, right? SBA is backed by an SBA SOP that constantly gets updated. And as of now, like Nick said, you're capped at $5 million generally for every industry, unless you're in manufacturing. Meanwhile, a conventional lender, Chase Bank, if they decide that you qualify for $20 million and it's a good deal for them, they'll do as much as, you need, so conventional definitely wins as far as that aspect. And so now, Nick, what are some reasons why a borrower, would go the route of a collateral-based loan, whether it is SBA or conventional?
Yeah, majority of the time when we're looking for this type of loan amount and we're using collateral, it's going to be multi-use case, right? Whether it be possibly business acquisition or a startup. That's the reason why somebody might want to go that direction. Maybe the cash flow isn't as strong, and we have to make up for that in a collateral-based sense. So that's probably another reason why a business owner would go that direction. But yeah, that's generally why we would want to see that.
100%. Larger use cases, multi-use cases, more complex, bigger, loan sizes are needed. Or like you said, if you just don't cash flow, now you have to use collateral to make the deal work in general. But another big reason why you have to use collateral is if the loan size is big, right? That's usually the main reason. And typically a loan sizes over $350,000 are the ones that require collateral. So that's why if as a business owner, you're able to work with, say, $300,000 or $350 on the dot, instead of going to $360, $370, $400, $400 plus, it might make sense for you to not use collateral, because now you can go through an easier process, less stringent requirements, and still get right around what you needed. But another reason why, a borrower would just go this route is just because they're just super qualified, right? An A+ qualified borrower where there's no crazy urgency or urgency at all to get the deal done quick. You're super organized. The financials are there. The collateral is there. If anything, you have more than enough collateral, and you can wait the long process. Usually these loans will take the longest out of all these different tiers of lending, probably more like a 45 to 60 day.
Yeah, I mean, we've seen it take sometimes even longer. Yeah, how hairy some of these files can be.
45 to 60 day, right? So you have to also understand opportunity cost. If you definitely feel like you can go through that longer process, you will usually get the best loan in every single aspect. You'll get the longest term possible, the biggest amount possible, and the lowest interest rate possible, which with collateralized lending, you can be looking at sometimes, prime on the dot, prime +1, even sometimes prime +2 if you don't, have the best credit. And so that kind of covers tier number 1, which is collateral-based lending, the hardest type of lending out there, the most complex type of lending out there, and, the longest, hardest process, out there. And so tier number 2 is cash flow lending, or you can call it debt service coverage ratio lending. This is where the borrower has to qualify based on their net positive EBITDA. All right. So say the business owner doesn't have collateral, or they have some collateral, but barely enough to cover your loan amount, but they do have the cash flow, right? So what is positive EBITDA? That's your earnings before interest and depreciation and amortization. And so if you go into any tax returns, you're going to see, your top line, which is your gross sales. You'll see your bottom line, which is how much you netted, right? Net income, net ordinary income. And then you'll have two lines in between that, which can be added back into that EBITDA, interest and depreciation. And so how a lender will look at your profile is, how much you made top line, but then what you made in the bottom is your net take home. And then they'll add the depreciation and interest. That's how much cash flow you have to afford debt. All right. So let's just use simple numbers. $100,000 is your net positive EBITDA. And let's say the business owner is already paying $20,000 a year in debt. Now you have $80,000 room of cash flow and you're applying for a loan. You just got to make the numbers make sense, right? What is the monthly payment you're applying for? Let's say the monthly payment you're applying for is $2,000. Now 2,000 times 12 is 24,000. They're already paying 20,000 a year. That's 44,000. Most debt service coverage ratio lenders require a ratio right around 1.25. You divide your net positive EBITDA divided by the yearly expected debt expense with the loan you're applying for. As long as it's a 1.25, you would cash flow, and you don't need to use collateral like tier 1 to get what you need, and you can still be approved. And so, Nick, what are some common requirements for a cash flow DSCR lender?
Yeah, for the DSCR lenders, we want to see time in business, 2+ years minimum. That's what we want to see. Well, we want to see good credit. With collateral-based, it was a little bit lower. With the good financials, we do want to see a little bit better credit. I think those are the two main things we want to focus on, as well as the financials. Obviously, we need the cash flow. I think that's most importantly with this second tier. But those are the two biggest things.
Yeah, 100%. As far as you're going DSCR lending, just make sure your business has at least 2 years in business, so you can show that you've been around long enough to actually be profitable, and that you have solid credit, right? Maybe not perfect credit because you have the cash flow, but it needs to be solid, minimal derogatories, and you can usually make it work. Now, diving into SBA versus conventional for DSCR cash flow lending. And so kind of comparing the two, SBA, usually, 9 times out of 10, you'll be able to find a lender that can give you a blanket UCC filing. All right. Now, this is the biggest distinction. With most conventional lenders that care about cash flow, they're essentially collateralized lending. So whether you're going for $350K plus, you're going for $150K plus, $200K, even $100K plus sometimes, depending on the bank, they're going to file a secured lien on your business. And SBA lenders can file a blanket lien. And so the difference between these different liens is whoever files a secured lien needs to be a first position. That means that if you have existing liens, they will need to consolidate what you have that's existing. And so a lot of times when you're applying for financing, let's say you need $100K to expand your business or $200K to expand your business, you already owe $500K on the SBA, $200K on maybe a line of credit with a different bank. It doesn't make any sense to refinance those two guys just so you can net $200,000. And this is where SBA kind of, takes the cake all the way, because now they can file a blanket UCC, which just goes behind any UCC you already have. It doesn't affect your existing obligations, and you don't need to use collateral, and you get the same loan as long as you have the cash flow. And so for this,
one thing I will add though is that with the conventional side, I know how you said that we'd have to consolidate. We can subordinate one loan.
Yes,
we can subordinate the IDL.
Yes,
which a majority of the business owners in America that have been around for 5+ years definitely have. So it's something that we can subordinate. So that's just something to keep in mind when we're talking about.
Nick is absolutely right. That's a very important kind of distinct thing to note. Is that you could, as far as UCCs, an EIDL wouldn't really count as a position, and even commercial real estate or equipment financing liens wouldn't count. So you don't need to consolidate those. But if you have any other maybe a business loan lien, conventional lenders need to take that out 9 times out of 10 if you're going for an amount that's over $150,000.
Yeah.
And so what are some other ways you can kind of compare SBA versus conventional?
Yeah. So
when it comes to cash flow lending,
when we're talking about the cash flow on the conventional side, one of the positives that I like to mention is that, we can work with one filed year taxes. I think that's a big selling point there. historically, when we're talking about SBA, we want to see year over year financials be profitable. When conventional, we only need to look at one file tax return. I think that's a very big selling point when looking at the cash flow based lending.
Yeah, we get a lot of borrowers where right now it's tax season, right? 25 taxes are getting filed for a lot of business owners, or they're getting prepared. And you'll have a business owner where, they have 2 years in taxes, right? So they qualify for cash flow lending, the minimum. The year before, 24, might have showed a loss, right? But now 25 might show a profit. And so 99 out of 100 SBA lenders will need to see 2 years straight, and they're going to do the median average between the two of the net bottom line you showed to get what you're trying to apply for now. Meanwhile, you'll have a conventional bank where you have just 1 year and they'll still approve you. So conventional definitely takes the cake as far as that. But then if you also look at SBA, the actual debt service coverage ratio is a lot more lenient. And so as we went over it with collateral, with just DSCR in general earlier, right? Usually the general rule of thumb is 1.25. But SBA lenders, because they had that government guarantee, minimizing the risk for the loan, they'll be okay with a 1.10. Meanwhile, you have your conventionals at 1.25. And so if it comes down to a situation where, they need the max loan amount and they qualify for both, that 15-point spread will give you, that additional 50 to 75 to 100K that you wouldn't qualify.
I think let's take a step back just 1 second. Let's talk about what the debt service obviously means. Obviously, we're talking about these ratios, and what do they actually mean, Travis? Right? So we're talking about a 1 to 1.0. What does that mean?
1 to 1.0, right? So you take your net positive EBITDA, right? Your net income plus any interest and depreciation. Let's just call it 100 grand, and then you take your yearly debt expense, right? Let's just call it 70 grand. You take 100 grand divided by 70 grand. That comes out to a ratio of 1.30. So usually the higher that right-hand side number is, the better, right? After the 1 point, the higher the better. That means there's more room for debt. You could also think of it like DTI, right? In personal finances, everyone's familiar with personal DTI, debt to income ratio. It's essentially a 1.10 would basically be a 0.90 DTI, right?
Yeah. So basically, in essence, just to kind of break it down a little bit further, for every dollar of debt that we have, we want to see $1.10 of profit. That's the bare bones of it. Obviously, the ratios go up. Dollar of debt that you have, we want to see $1.25 of profit. That's the bare bones of that. But I want to just kind of reiterate, because I think that's a really important fact when we're talking about these cash flow based loans.
Yes, absolutely. And again, if you look at like DTI, at a 90% DTI, an SBA lender will still approve you. Meanwhile, conventional lenders will always usually need a minimum of a 75% DTI. So it can usually make or break sometimes, the approval and just what makes more sense to focus on. And then the last thing with SBA versus conventional when it comes to DSCR lending, with that government guarantee and that lower risk, lenders will usually be okay with lower credit as well. We've seen SBA lenders approve people for deals just as good as conventional as far as rates and terms, longer terms as SBA, with credits as low as 650s. Most conventional banks will need 680s. And so,
yeah, I think the flexibility with the credit obviously is a big point when we're talking about cash flow here going SBA, right? I think that's probably one of the bigger things. Anything above the 150K to 350 mark, this is where it's going to fit right in. Again, medium-sized use cases.
Exactly. And you'll find most of these comparisons, the SBA kind of wins because it's an unfair advantage, right? If you're getting guarantees from the government, which is usually up to 75, 80%, it's usually going to be a little bit more lenient, and there's going to be a little bit more benefits and upsides going to SBA. But the main downside to SBA is just that because you have the SBA involved with the bank's parameters and the SBA parameters, it's going to be a little bit harder and longer of a process, a little bit more annoying, a little bit more paperwork, a little bit more waiting you have to go through. And usually, as long as that's not inconvenient for you and your opportunity, the SBA will give you a lot of upsides. And so, Nick, what are some reasons why a borrower should go, a cash flow lender instead of a collateral or a credit-based lender?
Yeah, like I said, good financials. Like I said, the credit is one of the biggest things. We are able to take a little bit of a toll on our credit just because SBA is flexible with that. Like I said, I think that's one of the bigger things there. And it's just good for medium use cases. Working capital. Just general expansion. Nothing too major like purchasing of equipment, debt refinance, stuff like that. I think that this is the main use for it. So,
Absolutely. And at the same time, you also have to make sure you're able to afford to go through a decent process, right? With collateralized lending, you have liens, you have the deed process, you have the whole 9 yards, the appraisal. That usually takes, at least 60 to 90 days. If you're going a cash flow route, it's usually going to take at least 30 to 45 days. And another main reason why a borrower would want to go this route instead of, say, a credit-based route is they need loan sizes that are decent. They need at least maybe 150K to 350K. And if that's the case, it would make sense for you to consider going a cash flow route that might take, 30 to 45 days. And so now we go into the final tier, which is tier number 3, credit-based lending. This is probably the most common type of lending out there, the most risky form of lending out there, and the most popular form of lending out there. And it's because if you have solid enough credit, you can get approved with very minimal paperwork. There's lenders out there that will approve you without really asking for financials, if any financials, and you're going to be looking at much faster turnaround times. And, some of the basic common requirements, would be at least 3 years in business. And what are some other requirements?
We want to see very good credit, right?
Yeah.
Like that's one of the biggest things. We want to see a really good credit profile on the personal side, right? We're talking about credit-based approvals. So, sometimes we're not looking at financials. It's no documents, stated income. Like we want to see a good credit profile, and we want to see good time in business. So like those are the biggest things that differentiate from the other two.
Absolutely. So business owners, if you want to reap the upside of really fast, easy, low doc financing, you definitely want to make sure you have really good credit, not just solid credit. A 680 is not good enough. A 690 is not good enough. A 700 with high utilization is not good enough. You want to be well over 7 with just almost perfect credit. No derogatories, no active lates, no collections, no balances. And you want to ideally have history too. You can't be, a 21-year-old college student with no history and, you have one credit card, with a 700 credit score, right? So now what are some ways to compare, SBA versus conventional, credit-based lenders?
Yeah, that's actually a great comparison here. So right now, on March 1st, there was a big change with the SBA. So now we're currently capped at $50,000. That's the max we can go for SBA, purely based off of credit, right? Or SBSS rather, right? When we're looking at conventional now, we can go greater than that. Anything greater than $50,000 on an SBA now is going to require that cash flow. So that 1-to-1 note, like we were talking about previously. So that's where the conventional side is really big here. It gives us the flexibility to go for the higher dollar amounts, the fast turnaround times. Again, the drawback, we do need a solid credit profile, not purely based on financials.
Absolutely. And like Nick said, March 1st, it just happened this month or last month where the SBA got rid of the SBSS. And, originally there were several SBA lenders out there that were pumping out, big loan sizes, cash flow loan sizes, 50 to 350K without requiring, cash flow, without requiring profitable taxes, without requiring collateral. And those are no longer a thing. And so now is a, really good time for conventional lenders to step up, take advantage. And we're already seeing a lot of banks, throwing out promotions. And, we definitely feel like they're taking advantage of the situation because there's definitely a huge market for these credit-based loans. You have borrowers that they might qualify for collateralized loans. They might have A, paper qualifications. They might have the cash flow, but they just don't have the time to go through all the paperwork. They don't want to use the collateral maybe, right? And this is where, it was a big hit for the market, losing these SBAs that were well over 50K. But this is where conventionals, as a business owner or a broker, if you're advising a business owner, to really understand the market and understand that if your business owner needs to go credit based and you need over 50K, conventional will usually do that for you because we see conventional lenders that can give you anywhere from 50 to 150K, without the cash flow, without the collateral, as long as the credit and the general profile is there, the time in business.
Yeah, that's absolutely right. We see it more and more every day. Especially working it, it's kind of crazy how fast it changed. The SBA kind of doing that really opens up a lot of new nuances and different opportunities for the conventional side. I think that's really cool. I think there's a lot of cool things that can happen there. So
Absolutely. And, if you're a business owner looking at this and, being pessimistic at all about, all these changes, it seems like the government's trying to take away, business owners, right, you guys' options at the end of the day. But, these markets have been around a long time, right? Conventional banks have been around since 1800. SBA has been around since 1950. And you're talking about $1 billion, hundreds of $1 billion, market share. And so just like the stock market, right? If you look at the last 20 years, it's always been going up. I think it's going to be the same thing with our market. One lender goes down, another lender will come up and replace, that funding. And I think the show will keep going on. It's just a matter of you being prepared, right? Adapting, constantly being able to learn, and not being stagnant. And as long as you're not stagnant, you'll be able to bounce back. Even for us, our clients, we haven't really lost a beat. It's just a matter of now we're funding more conventional. Now that SBA is not, quite maybe a little bit harder to go on the credit-based side.
Yeah. Absolutely.
Now, I'm going to go into a little bit of reasons why a borrower would go a credit-based route. So we kind of went into a little bit already, but as far as dollar amounts, it's key that the borrower is okay with, less than 150K, right? Because if they specifically need $200,000 and if they got 150K and they wouldn't be able to even get off the ground with what their plans are, they can't even spend $1 of it, then you got to consider using collateral if you don't have the cash flow, or going cash flow if you have the cash flow. But you have to ideally be okay with 150K or less if you're going credit base. And another primary reason why you go here is for the faster process, right? You might qualify for the other products, but you have a time sensitive use for the funds, right? You need to make payroll. You need to take advantage of an opportunity, inventory purchase, and your credit-based loan will usually be a 1 to 3 week process, right? With everybody, hands on deck, it's a smooth process. 1 to 3 weeks, you're done. You barely provide any documents compared to the rest of the programs.
We're seeing really fast turnarounds now,
Yeah.
really fast turnarounds. I think that's really big there too. Especially with somebody that doesn't have financials ready, they need the money faster, then they don't want to go the alternative route. They want conventional financing.
Or it could just be they just don't qualify for the others, right? They don't
True.
have their financials put together. They
Yeah.
don't have any collateral, and or the use case is just very simple, right? They just need working capital. They don't need to refinance that. They don't need to do anything too complicated, and that's why a borrower would consider a credit-based loan rather than a cash flow or collateral-based loan. And so, at the end of the day, what would you say the verdict would be? Who's better between conventional and SBA?
I mean, it's pretty cut clear here, to be honest with you. I think SBA does win, right? I think that's the clear verdict here. If you have a well put together profile and you're willing to wait, you're going to get the better deal, I think, with the SBA. Whether it be on the collateral side, whether it be on the cash flow side, or even if it's on the conventional side, right? You're going to get the better rate, the better term. Again, it's going to take some time, but if you qualify for that process, that's the way I would go.
Yeah, absolutely. At the end of the day, if you're just looking at, numbers to numbers, right, and common sense, SBA has more upsides. The downside is the fact that it's a little bit harder and longer of a process, a little bit more involvement. So if you just can't afford to wait, you probably would want to go conventional. Another fun fact about SBA is that if you have, negative government program history, you're going to be reported in what's called CAVRs as a default or a compliance issue. And, the cool thing about that is that as a business owner is that, you can still qualify for conventional financing, right? Conventional lenders don't necessarily look into the government database. And so that's also another reason why you might not want to go SBA, and why SBA might not be good for you is if you don't have positive government, program history.
Yeah.
You can still go ahead and apply yourself for a conventional credit-based option, cash flow option, collateral option. And as long as you qualify for that individual program, whatever negative history you have with government programs wouldn't affect you, so.
Yeah, I think it really just comes down to a business owner's needs, right? And what they do qualify for first and foremost. And then secondly, how fast they need it. I think that comes down to the nitty gritty of it. But SBA does win.
Yes. And so, with conventional, the biggest thing with them is if you're considering going conventional versus SBA, always ask yourself, right, am I applying to a lender that I have no relationship with or hardly any history with, or do I have a lot of eggs in that basket already? Because if you do have a lot of eggs in that basket, it always makes sense for you to see if they can do it for you. We had a customer where we thought the guy was going to go through a very hard, grueling process to get a 500K loan request with us. We prepped him on a 45-day process. He called up Chase Bank, who we already had a line of credit with. They literally approved him, and docs are going out within a week. That would not be the case for a borrower that doesn't have a Chase relationship, and you went to go apply with Chase for $400,000, $500,000.
Yeah.
And so that's like the main, I think, subtlety of why you would want to go conventional. And at Lexington Capital, that's what we do. Right? People will always tell us, I'd rather go to my local bank. I can save on fees, or it'll be easy. Why would I have to use you? And you should always vet that, and we always make sure we vet these people. So then you can really understand all these ins and outs, and you don't waste your time applying for the wrong financing, and getting too deep, spending all your paperwork, losing the opportunity for your business, and just educating yourself as well. Because at the end of the day, with our program, we're not transactional, right? We deal with business owners where we'll get window shopped, we'll get them offers, we'll break down the whole play, help them figure out their whole financials, figure out what program makes the most sense for them, and then they still don't move forward, and that's okay for us, because we're here for the long run. Where if they do come up with an emergency, an opportunity, and they remembered what we talked about, now they're ready, and they'll call us, and they'll appreciate how transparent we were originally. And that's just the whole purpose of what we're trying to do here, is really just be a leader in the space, be educational, be consultative, and then also be able to execute when it comes down to getting these loans originated for these business owners.
Couldn't have said it better myself. That's the game plan, and that's what we try to do every day. So, yeah.
100%. So, before we wrap this up, we definitely want to leave a little bit of time for some questions and answers. And so, any questions you have about any of these aspects or anything in general about SBA or conventional financing, drop them below right now, and we can, tell you the truth.
We have one question. What if my 25 taxes are better, but they're not fully filed yet?
If your 25 taxes are better but not fully filed, this is a great question. And so we deal with a lot of business owners where the 25 numbers might look beautiful, and the 24 numbers might look 1/3 as good. And so you would not be able to leverage your profit and loss to get the approval you want. The profit and loss, the way you should look at it is that it's a cherry on top. Your package should already qualify without the profit and loss, and then the profit and loss should just ensures that you get approved. So let's say the 24 taxes shows, $100K, right, profit, and the 25 profit and loss shows $150K profit. Now when a lender goes to the drawing board to approve you, they'll see, all right, 24 qualifies, and then 25 is they're showing growth, and they're actually a little bit more qualified. Now it makes sense. But when it's not going to make sense is when 24 absolutely does not qualify, right, shows 5K, and then your 25 P&L shows 150K. They're not going to take that with that much credibility to get you approved. It's just a cherry on top. You just want to always make sure your profit and loss looks as good, if not better, than the years before. But if it looks way, way, way better, just know that it's probably not going to get you approved unless the other years are qualified as well.
True. Another drawback, though, is that we could look at, contingent on the credit profile, we could always look conventional, right, using 1 year of taxes once 25 taxes are filed.
When they're filed.
But realistically, we want to see historical year over year to be, somewhere near the same. So.
And then last two questions. How do I inquire about an SBA, and would I be working directly with you two?
Yeah, you can apply right through our website, right? And you're able to, have a consultation with either Travis or myself. And yeah, you'd be working directly with myself and Travis and our whole SBA team. We have a lot of dedicated team members here that's willing to, look at your file, consultate with you, and try to figure out what you qualify for specifically and see what we can do for you.
Yeah, we provide free consultation for our service, and we have an East Coast team and a West Coast team. We're generally available 7 days on the week, and so you'll usually have access to us around the clock. And so as a business owner, or if you're a potential referral partner of ours, or anyone interested in our service, you can absolutely look to book a call with us through the website, reach out, whatever the case, and we can do exactly what we do, which is break down what your options are, what will work for you, what your plans are, and we'll just help you kind of put everything together. All right, so that looks like that's pretty much all the questions for today. So for everyone that tuned in, I want to thank you guys all for joining. It's always a pleasure to come here and share our wisdom, and be a leader, and a thought leader in this space. And do you have any final thoughts?
I just want to, thank you for having me here, being able to share my expertise here, and hopefully we'll be able to do this again soon and expand more once we learn more. you know?
Yes, sir. Bigger and better webinars on the way. This is the first of many, many more. And thank you all for joining. And any other questions or any